If you're someone who's looking to invest your first $100 and wondering how to turn it into $1,000, you're in the right place. I'll break down exactly how you can get started with the right mindset, realistic expectations, and simple strategies. In this video, you'll learn the realistic, step-by-step strategy to invest your first $100. How to find safe, low-risk investments that protect your money. Where to invest for higher returns without falling into risky traps. How to set up your finances for automatic growth so your money works for you even while you sleep. This is not about get-rich-quick schemes, but about building wealth gradually and responsibly. Let's dive in. Understand the basics first. Before we talk about where to invest your money, it's essential to understand some basic principles. Compound interest. This is the magic of investing. When you invest money, not only do you earn interest on your initial investment, but you also earn interest on the interest that accumulates over time. It's a snowball effect that grows your money faster as time goes on. Risk versus reward. Higher returns typically come with higher risk. You must balance your investments between low risk and higher risk opportunities to build a safe and rewarding portfolio. Diversification. Never put all your eggs in one basket. Spread your $100 across different investment vehicles to reduce risk. This ensures that if one investment performs poorly, the others might compensate for it. Step 1. Start with low-risk investments. Let's start with the safest place for your money, low-risk investments. These are good options for your $100 if you want to make slow but steady gains. High-interest savings account. This is one of the safest ways to park your money and earn interest without any risk. The returns are low, around 2 to 4%, but it's a good starting point. Make sure you choose a bank offering competitive rates. Certificates of deposit CDs. A CD is a great option if you're willing to lock your money for a set period 6 months, 1 year, etc. The interest is higher than a savings account, about 3 to 5%, but you can't touch your money until the term ends. U.S. Treasury bonds. Another extremely safe option is U.S. government bonds. You loan your money to the government, and they pay you interest in return. The returns can range from 2 to 4% annually. These options won't make you rich fast, but they'll keep your initial investment safe while earning small gains. Step 2. Explore higher risk for higher returns. Once you're comfortable with low-risk investments, it's time to explore options that could yield higher returns. But remember, more risk means there's a possibility of losing money. Here's where you can put your money for potentially bigger rewards. Stock market S&P 500 index funds. For beginners, investing in an index fund like the S&P 500 is a smart move. These funds pool money from many investors and invest in the top 500 companies in the US, like Apple, Amazon, and Google. Historically, the stock market has given an average return of around 7 to 10% annually. With just $100, you can start buying shares through platforms like Robinhood, Fidelity, or Vanguard. Exchange-traded funds ETFs. ETFs are similar to index funds but trade like stocks. They offer diversification by spreading your investment across many assets, including stocks, bonds, or commodities. It's a relatively low-cost way to get exposure to a variety of industries. Dividend-paying stocks. Some stocks pay dividends, which are a portion of the company's profits. This is a great way to make passive income while the stock itself potentially grows in value. Reinvesting your dividends can accelerate your investment growth over time. Step 3. Consider peer-to-peer lending and REITs. Now, let's talk about the other options you might not be as familiar with. Peer-to-peer lending and REITs. Peer-to-peer P2P lending. Platforms like Lending Club and Prosper allow you to lend money directly to individuals or small businesses. In return, you earn interest on the loans, which can range from 5 to 12%. While this is riskier than the stock market because the borrower could default, the potential returns are higher. Real estate investment trusts REITs. REITs allow you to invest in real estate without needing hundreds of thousands of dollars. By investing in a REIT, you own a small portion of real estate portfolios and earn dividends. These are a great way to diversify your investments into real estate with just a small amount of money. Step 4. Automate and track your investments. One key to successful investing is consistency and discipline. You don't need to constantly monitor the markets. Instead, automate your investments. Apps and robo-advisors. Use apps like Acorns, Betterment, or Wealthfront to invest small amounts of money automatically. These platforms can take your spare change or a set amount each month and invest it for you. Over time, these small, regular investments can grow into a sizable amount. Tracking your growth, it's important to keep an eye on your portfolio. Apps like Personal Capital or Mint allow you to track your net worth, investment performance, and expenses in one place. By regularly checking in, you can adjust your to $1,000. Remember, the goal is to start small, learn as you go, and build your financial future one step at a time. It's not about how much you start with, it's about the consistency and smart decisions you make along the way. Thanks for watching, and I'll see you in the next one.